Welcome back to the show. Oil prices surging in the latest session, at least, on fresh hopes of a production freeze from OPEC. How many times have we been there with this story in the last couple of weeks? West Texas jumping some 7%, North Sea Brent up 5% to those levels seen on screen. And meanwhile, the IEA out with a projection of a sharp fall in production growth rates in the next decade, as if that helps the present. The IEA saying it expects the US will lead global oil production increases by 2021. Can any of us understand what on earth they mean? Steve Johnson and Mark Todd, I mean, you're talking about the United States leading production increases. Well, correct me if I'm wrong, it was in their interest, was it not, to, of course, have cheap energy. I mean, it's in everyone's interest to have cheap energy. But for their own domestic producers, a rerun, the spectre of a rerun of Texas all over again is the least desirable option, which is what we are now inching towards, or are we not? What do you think on that front, in terms of banks lending to this sector and growing awfully tired of not getting their returns?
Well, capital markets have notoriously short memories, so the money will be back when the returns are there. And I think with the infrastructure that's been put in place, the ability to turn that US production off and on fairly quickly is now there, and it's ready to move when the time is right. So I think you will see more production out of the US eventually once the price comes back up. But it's relatively small still in the grand scheme of things. I know the Saudis were getting very concerned about how big it was getting, but it's 10 million barrels out of 90 million barrels a day. That could fall as low as 8, given the rig counts that we're seeing at the moment. So there's a couple of million barrels a day to come out of production there. It may go back up to 9 if the price goes back up. I think the big story, though, is the amount of capex that's happening in the conventional but non-OPEC part of the market, and that is taking time to flow through the system, but you're going to see big falls there that can't be replaced quickly.
Okay, your view?
Drill, baby, drill. As Sarah Palin said in 2008. I think one of the things to think about is what's happening in the high-yield credit market in respect to these guys. They used to represent about 15% of the high-yield credit market. It's now down to 10 because of what's happened in their markets. And I don't know that the banking... I agree with what you were saying about capital markets, but I don't know what's happened. The structural change in banking is making it harder to go back to that world to say, look, I will lend to you in the way that I used to. I think there is some challenges around creating credit for those organisations because banks are more conservative globally. That is just going to happen. So where will they get the money? Maybe that's the conundrum, but I do think the rig count is a really interesting data point on the Baker Hughes, and I think America will, if that price goes up, they'll go harder, and I just don't see that. I don't see the diplomatic coup taking place.
Well, it's timely because we've had the conference in Houston, the CERAWeek IHS conference. Pete McGuire, Crostas CEO at xm.com/au. Pete, hearing that discussion, and welcome to the program. Again, Abdullah al-Badri has been out in front. Does anyone really believe what he's saying at the moment about now, again, fresh talks, fresh agreements?
Well, good afternoon, Carson. Not necessarily. We've seen a strong rally in the last 24 to 48 hours. I think it's probably just a realisation that, it was probably oversold. I'm not suggesting that you're going to see $35 to $40 for WTI, but at the present time, it's been a strong momentum push up. You saw that weakness as far as the US dollar and probably a little bit of profit taking. You can wrap it all up, I think, just quite simply. I heard what your other guests were saying as far as rig count. You're worrying about what's happening as far as Iran entering the market. All of those factors need to be taken in. And as you see a higher price, if you do see 40 plus, then you're going to see a return as far as the shale revolution, and all of those producers will enter the market, and I think it's just going to end up with oversupply.
So as soon as you get a bounce back, you're saying it'll be offset by fresh supply coming back?
Well, exactly right. I mean, they're talking that. They go all the way. We've got 350 million barrels of oversupply at the moment.
That's your point.
Has to wash into the market. You've got huge numbers coming out as far as the Venezuelans, of course, Russia, and then you look at what's happening as far as the Saudis. Iran to produce more, and all of that factors into the market. So at the present time, it's the big casino. We've been short for a long time. I think there's just a time now it's whipsawing, and if you're on the right side of the market, one evening can make a very, very handsome profit.
I think in the short term there's no doubt about this oversupply, and I think the dynamic that people missed when it first started happening was you're Saudi Arabia and you're sitting there and you're quite happy at $100 a barrel and you're making a fortune, you're producing this stuff for $6 or $7 a barrel.
Yeah.
The price falls to 60. What's your reaction? You sit there and go, well, we need to pump more because we need more money. And I think that dynamic of more supply at a lower price has caught a lot of people by surprise. And the Oil Search CEO touched on this earlier, and it's a fact that the natural decline rate across the world for oil production is 6 or 7%. So if you don't spend a lot of capex, we're going to lose $5 million barrels a day of production every year. Now, we're not seeing that yet because we've got all this capex that was spent 3 years ago, 4 years ago, last year, that's still contributing to new production coming online. But you fast forward 2 years, we don't spend money, we don't get production, and it declines by 5 million, 6 million barrels per year. US shale is not going to grow enough to offset that. So I think this capex story, I don't know when it's going to play out, but it will play out.
So I'm just looking at Bloomberg right now. The Norwegian oil giant Statoil has just announced that it's going to double production in the Gulf of Mexico from 40 to 50,000 to 100,000 because it's saying it's much cheaper to be in the Gulf of Mexico than in Norway. So it's about moving its business over there, it's cheaper, and it's going to spend a bucket load of money to try and do it. And literally announced it 10 minutes ago. So I just don't see how the market isn't going to go to the US and say it's cheaper there, let's just go and try and make as much of this as we humanly can. So the Norwegians are saying, I'm going to go where it's cheaper, and they've cut staff by 20% and put their own managers in, and they're just going to run it again differently. So I just feel there is a structural supply that is going to continue on.
Not only that,
it's in their interest.
Not only that, Pete, you touched on Iran coming back into the fold. So you've got the Norwegian Statoil connection, but you've also got Iran that's been welcomed back into the bosom of the international community and then told, oh, and as the carrot for coming back and dropping your arms,
for the sanctions.
Exactly. You can't do any more production, so go and wither on the vine and go and be POV for the foreseeable. I mean, who are you kidding, Pete? No one in Iran will begin to agree to that.
No way in the world, and that's why they want their number to be back at 4 million.
It's just
also,
madness.
the other side, of course, is that they've got a bitter enemy, being the Saudis, to the Sunni versus Shiite, and of course the Iraq situation. So while they're producing at record numbers, Iran wants to enter the party.
Exactly.
We're all understanding what balance sheets. Saudi Arabia was $98 billion deficit last year. And if you look at the headline number, in 2012 it was $1.2 trillion as far as revenue from oil. Last year was $320 billion. That's global. So that's the contraction that we've seen, and that's very evident across all sovereign and, of course, all the oil producers.
And, Peter, the interesting thing about that is that the politics of all this, because, as you said, Saudi, the depletion in their reserves, how is it affecting their people, because they all work in government, and so the roles, when you think of these big producers, oil drives also their behaviour around how their culture goes, around how they're employing people. The US, it's different. They can switch it on and switch it off and go to different businesses. These big countries, they can't really do that. So Saudi, Iran, if they can't get
it's
oil,
the Middle East.
Yeah, the Middle East. If they can't get oil, what are they going to do to the people that sit in air-conditioned comfort that work there for that? For the government.
Yeah, and very little taxes, and of course the other side, cheap energy costs. So all of that's impacting a culture, it impacts generationally, and that's why they see the greatest fear that I think most of those nations have is social unrest. Yep. And that really plays into the whole quorum as far as the social strata. And if you see that you're going to see handbrakes across the Middle East as far as revenue, I'm sure it's going to play directly into to society and how that interplays as far as keeping everyone safe and happy. And I think that's one of the great challenges, and that's the China situation as well, if you look at the big picture.
The fact that you had the Secretary General of OPEC say at the meeting in Houston, quote, and referring to OPEC here, we are not dead, we are alive and alive and alive for many years more.
Many years to come.
Now, does that not speak of panic?
Well, I think it does. I mean, well, remembering they've got their own barra, they've got their own agenda, and they want to see OPEC continue for another 50 to 100 years, as long as there's the Middle East is going to be suppliers, and of course the Venezuelans and the Nigerians and so on. Remembering you've got Venezuela's got the largest oil reserves in the world, so that's a bit of a surprise or a wake-up call. So there's no shortage as far as South America being involved, then you're looking at what's happening as far as the US. So they're global plays, and it's the most important commodity probably after water in the world. So very crucial for mankind.
I don't think there's any doubt they're going to pump all they can, right? Let's take the most optimistic scenario, and Iran comes on board and everyone increases everything and they get to 34 or 35 million barrels a day. There's still 60 million barrels a day that need to come from the rest of the world,
right.
And the rest of the world is not producing it for $6 and $10 a barrel. They're producing it for 50 and 60.
Okay.
And I'm seeing companies go bust all over the place. You're seeing rigs being parked up all over the place. The capex is just not being spent in the rest of that market, and we need the rest of that market. Now, whatever OPEC's going up and the other stuff's not declining as quickly,
yes,
you're going to see a market that's out of balance, but that is going to change in the next 2 years.
Well, unfortunately, on that basis, we are getting the wrap-up. So, and remind me, Pete, where's the capital of OPEC? Where's the headquarters?
OPEC, Vienna.
Yeah, so not far from Oslo.
No.
So maybe
well, sort of.
Well, not okay. Thank you. Look on the map. Going to Vienna later this year. We'll talk to you soon.
Thank you.
All right. Take a break. We talked the share buyback from Qantas today. We were talking, where do you sit as preferred, as a owner in the structure for the Flying Kangaroo? Well, today, arguably, showing some displeasure, shareholders, as that buyback was announced, but the dividend wasn't sweetened. We'll be back in a moment.